Hey all, welcome to ShareTrek. This is Raj here. Today's video is not political, but it's pragmatic and squarely focused on our portfolio, and I really want your feedback on what you think, whether you consider this a risk at all. Today I share with you my thoughts for the short term. I think there are immense risks in the United States as we approach the November presidential elections. I'll articulate the risk to our portfolio, and I'll also share my thoughts on how I personally plan to handle these risks. Of course, like all plans, these plans are aspirational and I may not be able to execute 100% of them, but I'll definitely execute some of them to preserve value. So that's my disclosure. With that said, let's get started. Welcome back, friends. I'm thinking that regardless of who wins the presidential election, there's going to be unrest in the United States. If you think Biden will win, still based on recent history, you cannot rule out violence and disruption during and after elections. That said, what will happen to the stock market valuation? What will happen to the US dollar exchange rates? And what about the US bond yields? How will they respond to that kind of a situation? In times of crisis, money flows into American bonds for safety, but if the problem emanates from US and if the credibility of institutions are at all-time low, will people still push money into US bonds? Perhaps not. We'll have to wait and see what happens. What happens to the value of the US dollar will be something that we have to take into consideration. Well, the dollar will be momentarily weak until the crisis passes. That's my opinion. And currently many countries are under sanction, and there is a technology transfer ban and trade war with China. US dollar use in international trade has dropped to 53% as per the chart I showed you last time. And now the Saudis are reported to be selling oil in other currencies as well. Earlier, oil was only supposed to be sold in US dollars. So will the dollar hold its value? So that's the big question. Under these circumstances, as a Canadian, I have formulated a plan. Whether I can accomplish this plan is another story, but here it is. Here is my proposed asset mix. The first part would be gold and precious metals, around 20%. So this is temporary. Generally, you are not supposed to have more than 5% of gold in the portfolio. Gold is a very lazy kind of asset because it costs you money to store it, because you have to put it in a locker, it has to have security and so on. And if you were to go for physical gold, but there are various other ways of getting exposure to gold. So around 20% exposure out there seems good. And gold remains a robust hedge against uncertainty and inflation. It's a universal currency. It can be used anywhere. This can also be done by investing in gold ETF. So when I say gold ETF, I'm not talking about any gold ETF. The ETF should not have any minor stock. It should just have pure gold, that's all. So this will be a temporary holding for the crisis period, and I'll define the crisis period towards the end of the video. What is the duration I think is the crisis period. The second aspect is that we can invest around 20% in international government bonds. If we include high quality government bonds from stable economies like Germany, Switzerland, UK, Japan, this is expected to preserve value. So you could do one of those things. The exposure can come through ETFs or they can come through direct investment. And this is something difficult for retail investors to do. And I suppose that I would not be able to achieve this allocation either. But it is aspirational, as I said before. And then if I look at the next segment, I think there should be some cash in hand so that if there are some really good opportunities to capitalize on. So we'll keep around 15% in cash or cash equivalents so that it can be quickly converted into money and some distressed assets could be bought. And then, of course, utility stocks should account for around 10% of the portfolio. The rationality being that these are stable dividend-paying utility companies. Everyone needs utilities at all times, and it should be business as usual in these companies. I would say 10 to 20%, 25% on utility stocks is pretty good because you'll have preservation of value, first of all. And second is that you're going to get steady dividends. And thirdly, with the advent of AI and also crypto, which is well established now, the energy requirement is very high and as a result of which these companies are going to have a very bright future going forward. That said, we turn our attention to consumer staples, which again could form between 10 to 20% of the portfolio, because companies in this sector produce essential goods, ensuring steady demand even during economic downturns and times of difficulties. These will be business as usual in these companies, because they will be making bread, they will be making butter, they will be making jam, all the staples that are needed. However, I would stay away from retailers and those that are predominantly storefront, as they are likely to face problems in case of unrest. So something like Amazon seems very interesting, because whatever happens, they could always order from Amazon, and they don't have storefronts which are exposed. So that's the kind of thought I have. I would like to hear your feedbacks also. And then the other section where I would look at is 10 to 20% in defense stocks, because defense companies are likely to benefit from increased government spending on security, and also ADRs of European and Korean companies and other countries which have got really good companies. So ADRs are American Depository Receipts. The way I invest in CDRs, which is Canadian Depository Receipts, I use CDRs to invest in American companies, whereas companies from Europe, Korea, India, and UK, they all have their presence in the United States through what is called as American Depository Receipts, and we buy ADRs in the stock exchange like any other stock and get exposure to these companies. The rationale here is that ADRs provide exposure to international markets, particularly stable European and other companies. I would say you can go anywhere between 10 to 30% on this segment. Because this adds geographical diversion and diversification and reduces dependency on the US economy. I think that staying invested during inflation and during times of crisis can help preserve purchasing power. But what we stay invested in is very, very critical. It should be away from the main risk factor during that period of time. Here are some specific steps for selecting ADRs. I would research and identify stable and high-performing companies in Europe, UK, Japan, and Korea, probably India. I would look for companies with strong fundamentals and stable earnings and solid growth prospects. I'll give you some examples. In Europe, I'm thinking of Nestle, Novartis, and Siemens. If you have to look at UK, Procter & Gamble comes to mind. And in Korea, we have Samsung Electronics, Hyundai Motors, and SK Telecom. India is hot, and those that understand Indian stock market and have access to the Indian stock market can invest there. I have access, and I do invest in Indian stock market. You could select any country with a growing economy and a reasonably stable exchange rate. For India, I would say that there are companies like Reliance Industries, TCS, and ICICI Bank, to name a few. If you don't have direct access to the Indian markets, then in the ADR sector, you will find ICICI Bank, Wipro, and you will find Infosys. These are all companies which are really strong companies in India, and their ADRs are present in NASDAQ. So I think that kind of a diversification would help a lot to tide over the difficult times. And who knows, when you are trying to diversify, you may probably get some really good deals and also exchange rate benefits. So it's all up in the air. But these are my thoughts. And I'm thinking that the best time frame to make the switch is 3 to 6 months before the election. So we are in that sweet spot right now. I think the elections are going to be on 5th of November and we are on 25th of June. So we have July, August, September, October, November. So we are in that 6-month range. But as we go closer to the 3 months, I think we'll start experiencing volatility in the market. That's my personal opinion, and I would like you guys to let me know what you think, because the memories of January 6th from the previous election is still fresh in many minds. So I would begin transitioning my portfolio to incorporate ADRs, ensuring I'm prepared ahead of the potential market volatility. And I think that if the risk during the period between September 2024 to February 2025 is navigated, the capital can be redeployed, and possibly you could buy some counters that cheaper than when you sold them. So of course, these are my personal opinions, and I'm curious to hear your thoughts. Please let me know if you feel any risk at all due to the impending elections and how you are planning to handle it. That's all from me for now. And before we leave, I would request that please press the like button and share this video with your friends. We need 20K subscribers. We are very close, and your help can help us push us over the 20,000 mark. So that's my request. And with that, I would like to say bye for now. See you in the next video.